Hi. Let's learn about the humped yield curve. A humped yield curve is a relatively rare instance when medium-term fixed-income security interest rates are higher than both long- and short-term instruments. If short-term interest rates are expected to rise and then fall, a humped yield curve will form. It's also known as a bell-shaped curve. The yield curve graph, also called the term structure of interest rates, displays the yields of similar quality bonds against their time to maturity, from 3 months to 30 years. It provides a quick overview of yields for short-term, medium-term, and long-term bonds. The shape of the yield curve offers insights into future expectations for interest rates and macroeconomic activity. A humped yield curve occurs when the yield on intermediate-term bonds is higher than the yield on both short-term and long-term bonds. Unlike regular yield curves where investors receive a higher yield for purchasing longer-term bonds, a humped yield curve doesn't compensate investors for the risks of holding longer-term debt securities. If the yield on a 7-year Treasury note was higher than the yield on a 1-year Treasury bill and that of a 20-year Treasury bond, investors would flock to the mid-term notes, driving up the price. The long-term bond would not be as competitive. The humped yield curve is an indication that some period of uncertainty or volatility may be expected in the economy. The bell-shaped curve reflects investor uncertainty about specific economic policies or conditions. A humped yield curve is not to be confused with an inverted yield curve and may form as the result of a negative butterfly. An inverted yield curve occurs when short-term rates are higher than long-term rates, indicating that investors expect the economy to slow or decline in the future. However, a humped curve is bell-shaped and may indicate uncertainty about economic policies or conditions. Here are 3 key takeaways. 1. A humped yield curve occurs when medium-term interest rates are higher than both short and long-term rates. 2. A humped curve is uncommon, but may form as the result of a negative butterfly, or a non-parallel shift in the yield curve where long and short-term yields fall more than intermediate one. 3. Most often yield curves feature the lowest rates in the short term, steadily rising over time, while an inverted yield curve describes the opposite. A humped curve is instead bell-shaped. Hope this would help. Thanks for watching.